While everyone is waiting for the markets to crash, it looks like another leg up is just about to take off. And in this video, we're going to look at the signs that you should be watching. We're going to look at what the Snowflake IPO is telling us about the markets, and we're going to show you exactly what you need to be doing to be positioned to play this out right now. So stay tuned. Hey, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about making money. I like to talk about growing our money. I like to talk about protecting our money. These are things that you should be concerned about because it's building wealth and money that gives you the options that you need in life. If you like those types of topics, click the like button right now so more people can find out about them. Of course, click the subscribe button and the bell notification so you're notified every time I put new videos out. Now, today we are talking about the markets, of course, and a lot of people are waiting for them to crash. They've been waiting for a long time, but it's looking like they are ready for another leg up. And so I want to show you about that. Of course, the big news that just came out that's really pushing this narrative is, of course, from the Federal Reserve. The Federal Reserve is the one driving the market. The market and the economy have become separated. Forget the economy. Look at the Fed. They're driving the market. Now, of course, if you've been watching this channel, I talk about it a lot. And so you might have already been expecting what we heard. I was expecting it. And basically, we saw Chair Jerome Powell. He said during a post-meeting press conference that the central bank plans to keep its low rate easy money, quote unquote, policies in place. Now they've agreed to basically keep rates pinned all the way down to the floor, literally pegging them to zero and then just leaving them there. That's it. Like, that's their plan. Put them to zero and leave them there. Powell said that would be the case until inflation rises consistently and maximum employment is reached. Now, we've talked about this a little bit before. The Fed policy targeting maximum employment. It's a pretty big shift in policy. Of course, we don't know what maximum employment is. They haven't given us a number. And so I guess they're basically just going to go full guns blazing until something happens. Now, also of note, the individual projections of Fed governors showed that most expect rates to stay down at zero through the end of 2023, so about 3 years. So what does that mean for us? What does that mean for our money? What does that mean for the markets? Well, if you've been watching this channel, then you already know, like I said, the artificially low interest rates and the fast rising Fed balance sheets, they're basically gasoline being poured on the market fires. And they're creating the biggest bubble, the most frothiest bubble, the melt up, as we call it, the melt up in stocks. And I know this sounds crazy, but even the start of a new bull market. I know, right? It's crazy. The start of a new bull market. Now, I know we have weakness in the markets. The last couple of weeks, the Nasdaq's down a little bit, but all the key indexes, the S&P 500, they're all holding up with support so far. Now, what we're also seeing now is a rotation between different sectors of the market. All right, so the tech sector is down about 12% at the time of this recording anyway. And it's right at about the 50-day moving average. And we're starting to see money pivot into the industrials and the materials sector, which are both surging now to new all-time highs. And so seeing this rotation of funds moving from one sector to another, what it typically shows us is that the market is basically still in an uptrend. Now, I know. I already said it, right? The economy's wrecked. Unemployment's still at record highs. But the stock markets and the economy are disconnected, as I said, right? The Fed is driving the markets, for now anyway. We have central banks around the world pumping trillions of dollars, euros, yens, whatever currency they have, and they're pumping them into the economies. And this has been the reason why we have and we're going to continue to have higher asset prices. Now, of course, I don't have a crystal ball. I say it all the time. I sure as heck wish I did. If you find one, let me know. But one of the reasons why I continue to be bullish, at least for now, is because one of the best ways to see price trends is moving averages. All right. So there's a bunch of different indicators. I mean, there are, hundreds of indicators that you look at, and they all need to add up for a picture. But one of the easy ones to look at is just moving averages. So during a bull market, assets tend to spend most of their time above a moving average. And then during a bear market, they're going to spend most of their time below the moving average. Now, the other thing that I like to look at is the direction of the moving averages themselves. So the moving averages are the trends, right? So we like to invest with the trend. I'm a surfer, so I like to catch the wave. I'm not a professional knife catcher. I'm not trying to guess before the market turns. I wait for the trend. I wait for the wave, and then I like to ride it. And so the moving averages are those trends. And when they're moving higher or lower, lower, then assets often continue to move in the same direction. Now, the 50-day moving average is the average of an asset's closing price for the prior 50 trading days. Now, there's different time frames you can look at: 200, 50, 20, 10, whatever you want, but 50 is a good one to be looking at. Now, we use it to gauge the intermediate trend. So we look at a 200 to look at more at the long trend. But in the intermediate trend, what we're seeing right now is that there's several assets that are sitting right on their major support line levels of their 50-day moving averages. Now, typically, when asset prices test their support lines, this is where people tend to come in and start buying. Now, we can see this in the S&P 500, we can see it in the NASDAQ, the Dow Jones, the Russell 2000, even emerging markets, gold, Bitcoin, they're all showing about the same thing. Now, I don't want you to think this is a guarantee of what's going to happen in the future, all right? Like I said, I don't have a crystal ball. There's nothing guaranteed, but this is bullish for another leg higher, at least in the short term anyway, because historically, when an asset is in a bull market, in an uptrend, and it pulls back to its 50-day moving average, then it's usually a buy the dip moment, all right? So you hear the buy the dip, buy the dip. Well, if it's in an uptrend, a bull market, and it pulls back to 50 DMA, then it's usually a good time to do that. In a bull market, we can see, when we're in that bull market, we can see assets push way above their moving averages. And then at that point, they're overbought and they're ready for a pullback. And if they pull back down to that 50, then it's a good time to buy because it takes a lot of that risk off the table. So these tests, when they come down and they test the average, we call them a test. These tests of the moving averages provide a much lower risk entry price. Plus, from a pure technical analysis perspective, which I'm not a huge proponent of, I do use it a little bit. Obviously, we're talking about it, but the traders who do watch these, they definitely are watching this 50 moving average, and they use these tests as entry points as well. Now, never said the stock market perfectly reflects reality, because it certainly doesn't. I also haven't said that easy monetary policy is good for the economy's long-term health. In fact, I constantly make videos saying the exact opposite, right? If those things were true, it'd be really easy for anyone to basically just come in and make money all the time. Unfortunately, it's just not that easy. But in reality, we have to work with what we have, right? We just play it bar by bar, chart by chart, right? We just play with what we have. I like to say that we don't invest in the market as we want it to be, as we think it should be, but rather as it is. And so today, despite the quote unquote world-ending scenarios that are in the economy, we still see stocks are going higher. Now, this is because the central banks of the world are pumping incredible sums of money into the economy and the financial system. And like I said, this is causing huge asset bubbles all over the place. Now, we don't know when these rallies are going to end, but based off of what the Fed and the government's doing, what they're saying, and then also looking at the markets and what their response is, I don't think they're ending just yet. Now, some other signs that I'm watching also back up this thinking. So for example, we're seeing some super frothy behavior. There's lots of companies and mergers that are happening right now. Now, these usually happen during good economic times, and it's a signal that more positive economic outlook from the buyers involved in the deal. So typically you're not going out and spending a bunch of money if you don't feel good about the future. Now, a couple notable acquisitions that we've seen. We saw semiconductor designer NVIDIA. They announced that they're acquiring chip design firm ARM Holdings for $40 billion. Yep, with the B, $40 billion. Again, that's a huge sum of money to buy if you're uncertain. We also saw biotechnology company Gilead Sciences. They announced they're buying their competitor Immunomedics, and they're buying them for $20 billion. Another massive, massive acquisition. We saw telecom carrier Verizon. They disclosed plans to buy prepaid wireless service provider TracFone for about $7 billion. And then the biggest announcement, which I'm sure you heard about, is Oracle. And Oracle announced that they are going to buy TikTok. Of course, the U.S. government moved against TikTok. I think it was Microsoft originally was going to buy it, and now Oracle is going to buy it. Now, all of this is very bullish because this is what we typically see when companies are looking for quick ways to get more growth. They spend the money they have. They make acquisitions. The CEOs are starting to look for opportunities to snap up other companies when they believe the market is mispricing an opportunity. They're looking for undervalued deals too, right? So they're looking for mispriced things. Maybe because people see the economy down, they're mispriced. They think they're getting in at a good deal. So these are really big deals, all right? You're not making that type of commitment unless you feel pretty certain about the growth outlook and then, potential going forward. Now, if all this isn't enough, We got more signs of market irrationality, or what I call frothy behavior at the top. And this one was making big news, and it's actually the title of the video. And this is the cloud software data warehousing company Snowflake. So the title of the video, you've heard about it, Snowflake. What the heck is it? Well, it's an IPO that just happened for this cloud software company, and the IPO doubled. It doubled, which made it the most lucrative software stock debut in New York Stock Exchange history, which is amazing because I think just last year we had all these IPOs that were coming out and losing money, the big ones, the Ubers, the Lyfts, etc. And now we have this one doubling. And of course, one of the most famous investors in the world cashed in, good old Uncle Warren Buffett, his company, Berkshire Hathaway. They were an early investor in this company. They made about $1 billion in one day as the stock went up over 100%, 123%. Now, the reason why I bring this up is because Warren Buffett's been pretty outspoken against IPOs, all right? He's been outspoken against gold, and now he just bought gold. He's been outspoken against IPOs, and now he did an IPO. The other reason why I bring this up is because, as I've talked about many times, he had hundreds of billions of dollars on the sidelines. He couldn't find any good places to put the money, but now he is. Now he's putting the money to use, which further makes me think this cycle could just be starting. For some reason, he's now deciding to spend his money, Barrick Gold, Snowflake, etc. But let me say now, and let me make this very clear, a couple of things. First, remember the economy and the market, they're not the same things, all right? Also, I still think a big crash is coming. The problem is timing it is impossible. It could happen in Q4 of this year. It might happen in Q1 or 2 of next year. It could be even longer, right? I don't know how many more magic tricks the Fed has up its sleeve to pull off, but from what we can see in the near future, at least, it looks like the melt up into the blow off top, it looks like it's still on. So how do you play this? How are we going to play this? How are we going to make money, and how are we going to protect ourselves from the blow off top? Well, the saying in investing is cut your losers short and let your winners run long. So if you're in some good positions, then you got to stay in them. Just stay in them, and then you move your stop losses up or adjust your trailing stops so that when the market does, and I say does, when the market does finally crash, then what happens is you're going to lock in your gains and your profits, all right? So adjust your stop losses, your trailing stops. Also, make sure you're managing your risk using the 2 other main tools to manage your risk. 1, your allocation strategies, and 2, your position sizes. And of course, always never invest what you can't afford to lose. Now, let me know what you think. Do you see the market has more room to run, or do you think it's done? And if you need help with allocation strategies and position sizes, I have a free report linked in the description down below. I'll pin it in the comments as well. It's my free gift to you. Download it, and it's going to teach you how to set up your allocation and your position sizes to manage your risk. And that's it. Leave me a comment. Let me know what you think. Give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down either way. But of course, leave me a comment and let me know. And that's all I got. To your success. I'm out.